It has been a rough, and I mean a rough week and month for software as a service stocks. But one of those stocks reported after the market closed today, and it had banner numbers. Enough so that I feel comfortable saying it is the best, if not one of the best, SaaS stocks to own right now. It's one of the best stocks for me to own, whether it's SaaS or not. And that company is none other than Axon Enterprise. It reported earnings after the market closed today. Shares were up by as much as 17% after hours. So what does this mean for shareholders moving forward? Well, my name is Brian Stoffel. We'll spend the next couple of minutes trying to figure that out. I want to give a shout out to Fiscal AI for sponsoring today's video. And as of the time of this recording, I am and have been for almost 10 years an Axon shareholder. So this was the company's fourth quarter of last year. When the market opens tomorrow, it'll be somewhere around a $40 billion company. For those unfamiliar, Axon is also the company behind police taser guns, body cameras, and the software systems that run on them. So, headline numbers first. Revenue was up 39%, which was well ahead of analyst estimates, and it beat management's own guidance. Beyond that, earnings per share was up 29% and also well ahead of analyst estimates. So far, that looks really good. But what you're about to see is a bunch of news that's not so good. And that's important because I'm going to be making an interesting proposition here, which is that these were good earnings and the stock is actually cheaper than you might think. Here's what I mean. If we look at gross margins, they contracted. That is never good. Operating margins contracted, and they were already negative on a GAAP basis, which includes a whole lot of stock-based compensation. Net margin was artificially high in the fourth quarter of last year because of some tax situations, and it was basically break even. And it wasn't great news on the rest. Free cash flow actually fell. Net income on a non-GAAP basis was pretty much flat. The balance sheet, the company took on a lot of debt, but it did so to make some really important acquisitions that we'll get to in a minute. So all in all, these numbers don't look great. Certainly not to the point where you'd see a company's stock going up 15 to 20%. Let's look at the income statement so we can suss this out. Overall sales were up 39%, but the cost of those sales were up even more. That's not great. Let's break it down by products. Those are the tasers and the body cameras, and services. That's a lot of the software systems. If we look at the products, the gross margins contracted from 49% down to 46%. That's not great to see. I wasn't able to find too much color commentary on the conference call to explain this out. I could go back and find more later. I will say that this is less concerning because what's more important are the gross margins for the service revenue, and that did contract as well. However, there's a couple important things to know here. Okay, because this is software, there's a lot of front-loaded expenditures with building the AI era bundle, which is what makes Draft 1 possible, which is a huge boon for the company. It fills out, it auto-completes the first draft of a police report for police officers, which cuts down the amount of paperwork that they have to do immensely. But it's not just that. Fusus, which allows many different data feeds to be fused together in order to allow for real-time operability. That is an acquisition that is just now being integrated, and so that can be a drag, as well as Axon 911, which came from an acquisition as well. These are all front-loaded, and so because of that, that does explain some of this pullback in margins, because all of the money that was spent to build it is considered in the gross margins, and because it is functionally almost free to give out further licenses to use this software, that has yet to kick in and allow for it to boost the gross margins up. That being said, because of it, gross margins were only up 33%. That's coded red because it's slower than revenue. And operating expenses were up 41%, which isn't great either. A lot of that is stock-based compensation. Now, you combine all this, and on a GAAP basis, losses tripled. Operating losses tripled. That's never great to see. And despite the company handing out tons of stock-based compensation, The number of shares outstanding diluted was actually only up 2%. And part of this is because it is such an expensive stock. And so if the stock is expensive, then they don't have to dilute shareholders a bunch to offer a whole bunch of stock-based compensation, which is kind of something that a lot of investors might not realize when they look at the absolute numbers of stock-based compensation. Now, there are a lot of moving pieces here, and I'm going to take time to explain all of them, but we're going to start by heading over to Fiscal AI, which I think is probably the best free tool you can use if you're an individual investor. Now, if you click the top link in the show notes below, it'll take you right there. And if you get a full year membership with full functionality, you'll get 15% off for doing that. Now, the first thing I want to do is I want to point something out. What I'm showing right here is quarter by quarter the revenue growth rate for Axon since March of 2023. And this is remarkable. With the exception of this one quarter, holiday quarter of 2023, their revenue growth rate has stayed in this 30% to 35% range. But let me now pull in the most recent quarter, and you can see how impressive this is because it accelerated all the way up to 39%. That's impressive. Really, really, really impressive. And if we look at the annual numbers right here, it shows you that this company has been growing at over 20% ever since over the last 10 years. And it has been re-accelerating lately. It was growing at 22% in 2018, 27% in 2021, and now it grew at 34% in the last quarter. And that is an acceleration from the previous year as well. That's not the only thing we can look at. We can look at the different ways that the company breaks down its revenue. The first is just by taser revenue. So this is the stun guns. And what you can see here is that not only is it growing well, but that growth rate accelerated to, in this quarter, 32% growth for tasers. That's great to see. Let's then look at personal sensors, which is mostly the body cameras and things like that. And again, we see that revenue growth rate accelerated to 28% growth. We can look at platform solutions to see where this is. And again, we see that the growth is impressive at 81% growth. But really, the most important one by far is the software and services revenue and revenue growth. And what we see is while the revenue growth might not have been as fast as the previous quarter, look at where these growth rates are. 39%, 39%, 41%, 40%. This is evidence.com and all of the surrounding software solutions that the company has built gaining significant traction over time. One last thing that I think is worth pointing out. This first one is SaaS or software as a service recurring revenue. What we see here is that grew 35% during the quarter. While that growth rate is a little bit slower than it was before, you'll see in a minute why I'm not too concerned about that. The bottom line is their SaaS revenue. I mean, look at this. Coming out of lockdowns, coming out of COVID, basically, their SaaS revenue is sitting at about annual recurring revenue at about $330 million. Okay. 4 years later, it is at $1.35 billion. That is just 4 years over this time. That is 42% growth rate over this time. And it has continued to do well. The one number that really impressed a lot of people, myself included, is this future annual contracted bookings. And you see this enormous jump that happened from the last quarter to this quarter, showed 42% growth to $14.4 billion. This is important because we're talking about a company that just closed on less than $3 billion in revenue for the year. So they're showing that the pipeline for this growth is incredibly, incredibly strong, which is incredibly, incredibly encouraging. So there is a lot of things going on there that were great to see. What else happened that did they reveal during the quarter? Well, first, analyst estimates were calling for 24% revenue growth during this year, 2026. Management blew that out of the water. The midpoint of their guidance is for 29% growth. That is impressive. As a shareholder myself, what am I watching? And I haven't even gotten to the most important thing that they revealed. I'm going to watch net revenue retention, which, you know what? I forgot to show it to you, so let's look at that net revenue retention. The net revenue retention, what this does is that this measures the total amount of revenue that a cohort generates from one year to the next. So it doesn't include all the new customers you get. And what we see here is normally net revenue retention, it slowly decelerates over time. But with Axon, we have seen it accelerate continuously, and it hit 125% during this quarter. What does that mean? If you don't include any of the new customers that Axon got, the international, the commercial, the consumer customers that they've gotten, just the customers that existed in December 2024, and you take that group and you say, how much revenue did that cohort bring in December 2025? The answer is, they not only held on to, on average, all their customers, but on average, they spent 25% more in just 1 year. That is how powerful the momentum here is. And that is why that's the first thing that I would keep my eyes on. The second would be what I'm calling green shoots. Now, what does that mean by green shoots? It means all these new projects that the company has that have potential to really take off, like the AI Era Bundle, like the virtual training that management talked about that you can do using Axon's services, like the 911 dispatch, like the Fusus, like Dedrone and Axon Air. Commentaries on those are a huge part of integrating this entire system. Number three, I'm going to listen for not only what is the future contracted revenue, but what is the commentary on future contracted revenue. And number four, margins, just all of them, the gross, the operating, and the free cash flow margins I'll be curious about. Now, I know that they might have to take some steps back while they're building all these new things because that's what happens to margins, but I want to keep my eye on that. As far as I'm concerned, the moat around this company continues to get wider and wider and wider, and the thesis is very much on track. But I still haven't got to that one big thing that they released during the quarter that has me the most excited. Now, before I get to that, I do think it's worth pointing out, this is a stock, and I'm showing my actual right here at the top. I blacked out some of it, but this is a stock that I have held, as you can see here, since it was trading for $22.51, all the way back here in 2017. There was a 20 bagger before today. It'll be much more than that afterwards. You can see that it has been a huge long-term winner. It is a stock that I talk about in my community, Stock Investing Mentor, a lot because it's one that I believe in and that it captures my idea of anti-fragility quite well. Now, if you want to join Stock Investing Mentor, there's 3 parts to it. The first is 1 hour of live and recorded sessions every Thursday at noon Eastern. The second is you get full access to my portfolio, as well as a video description of any moves that I make within my portfolio. And third, 24/7 access to a private online investing community. If you're interested in this, simply click the second link in the show notes below, and you'll get 10% off if you register by the end of this week on Friday at 11:59 p.m. So, what is this other thing that they talked about during the quarter? It was this. Management said that they now believe that they will have $6 billion in revenue by the end of 2028. $6 billion in revenue by the end of 2028. Now, let me just show you what that means. Okay, first of all, before today, most analysts were calling for $3.4 billion in revenue this year. The management just guided for about $3.6 billion in revenue. But this is even more important, okay? If we go and we look at where is revenue right now and we look at it on an annual basis, we're sitting on $2.8 billion in 2025. In 3 years' time, management said we will get to $6 billion. If you do the math on that, that is an annualized growth rate over the next 3 years of 29%. 29%. Let me take it a step further and show you something here on Fiscal AI. If we go to their estimates and we go and see how accurate have analysts been when it comes to guessing what Axon will do, they have always underestimated what the company will do for as long as we've got records of to show right here. It continually moves up from 1.1 billion, and this was back in 2023, to almost 1.6. And this just follows. They continually beat guidance. So I personally would not be surprised at all to see Axon show that it grows at least 30% over the next 3 years. I wouldn't be surprised if it was even faster than that. Here's why this matters. The biggest knock on Axon, other than their stock-based compensation, which is high, I'm not going to beat around the bush on that, is the fact that its valuation sounds ridiculous. But I don't think that we're looking at the full picture here. And here's what I mean. Okay, we could look at the standard metrics, like it's price to earnings or price to free cash flow. On a price to earnings basis, we're talking about a company that right now, I've got it on quarterly, I need to put it on annual. Right now, we are talking about a company that is trading at about 280 times earnings. And its free cash flow, according to this, about 445 times free cash flow. So, yeah, that looks ridiculously expensive, but it also is the wrong tool to use to look at this, in my opinion. Here's why. First, I think if we optimize the free cash flow margins, that might get us a better idea of what the company could do. And here's why this matters. All the way back, if we look all the way back before the body camera business, when this was primarily just a taser company, it was able to have free cash flow margins of 22%. Now, if you layer on fully mature software business on top of that, how high could it be? I believe it could be at least 30%. But let's bring it down a little bit to factor in some of that stock-based compensation. And let's give them, say, a 28% free cash flow margin. Here's why that matters. They've got $2.8 billion in trailing revenue. If we gave them a 28% or about 28.5% free cash flow margin, that would give Axon about $800 million in optimized free cash flow today. And here's why that matters. If we go to this reverse DCF calculator, oops, wrong thing right here. And we're going to put in our ticker symbol, which is Axon. And we put in that optimized $800 million. And we assume that has a 3% terminal growth rate. Now, right now, the stock is trading for about $511 per share. So we want to make this green box be 511. And what do we need to bring it to? Well, we just need to bring it to about 19. So what does this mean? It means that if Axon can get about a 28% free cash flow margin, optimized free cash flow margin, and grow its revenue by 19% per year over the next 10 years, then this stock makes sense to own. It will at least be market matching and return 10% per year because that's a discount rate. The fact of the matter is we know that over the next 3 years, I am strongly confident that it can return 30% per year. Now, if you get that 30% growth in those first 3 years and then it slows down after that, what kind of growth rate could that be over 10 years? Well, you know, if it was 23%, that would make it a $682 stock. And so I actually think that despite that high PE ratio, that this is quite a good deal right now. And so I'm not surprised to see it going up. And this is one that is, after tomorrow, it's going to be one of my largest holdings. So I think this was a very, very good quarter for Axon. If you'd like to see if I'm even going to add to it, don't forget to click that link for Stock Investing Mentor. Let me know what you thought of the company's earnings in the comments section below. And don't forget to hit subscribe so 90 days when they come out with their next earning, you can get the next update. Until then, Brian.